versus pound. So that's the normal process that goes through my mind when I'm looking at charts. That's when I go through those types of questions internally. That's the internal dialogue I have. But when I'm looking at index futures, what I'm looking for is all the things that I have taught so far to you. The PD arrays, order blocks, market structure, fair value gap, working with order block and breaker and mitigation, and then looking for low resistance liquidity runs. If I think I see a setup there, I will not take that trade unless it has this signature here. One of these index futures has to say, no, I don't agree with that. And you see that here with the Dow. We have a higher low here, lower low in the S&P, lower low in the NASDAQ index futures. So what is in play? The run below these equal lows for the sell side liquidity. Buy up those stops, send it higher above the relative equal highs that has the lower to the right. Notice it's lower here. So it's a very easy low resistance liquidity run. Okay, so I want to take this off and kind of walk backwards through this and show you the scenario. So this is what the chart looks like without all of that other lipstick. And the way you get that on your chart, in case you're wondering, in one trading view, right about in here, you can't really see it because I have everything just recording just to the top of the box here. So just north or right above where I'm pointing, you can't see it, there's going to be a circle with a little plus symbol and the word compare. When you click on that tab, this is what pops up. So if you ever want to pull up a index future SMT study, load the E-mini S&P. Right now we're looking at the ESM as in Michael 2020. That's the symbol you put up in there. And then once that's there, and we're getting ready to trade into June. So eventually this coming month in June, the June contract will expire and then we'll move to September SPOOs. So September contract month is the letter U, like umbrella. And you would use ESU 2020 for the E-mini S&P futures contract. And then where it says June here, it'll say SEP for September 2020. But whatever you're using for the index future, like this here, S&P E-mini for June contract, the symbol for June is M, and you would load up Y, M, letter U for September 2020, which is the year. Okay, and then you would just click on this, and then it would add, there's your symbol, and that's your Dow, and then you would use NQU 2020. That's the NASDAQ E-mini futures for the contract month delivery of September. Click on that, and it adds it there. And you can just click on it and change it to whatever color you want it to be. But I'm not keeping these on the chart because I already have the June contracts comparatively. And then you could just see where the SMT divergences occur. And you'll see all the turning points have to agree with the indices. And if they don't agree, then you're seeing a crack in correlation. And there's underlying distribution where we have the higher high here. We don't see that in the Dow. We do see it in the NASDAQ. So what happens? The market trades lower. What is it doing? It's taking the sell side liquidity out and trading back down into a discount. Market's making lower lows here. You see that? It makes a lower low in the Dow. But is it doing it in the NASDAQ? No. And then we have that rise on Friday. So it allows you to see with an X-ray view when we are looking at things that would otherwise give us an inclination to be bullish or bearish. It gives you the X-ray vision of seeing whether there's real accumulation or real distribution in the marketplace. So it's, to me, it's just a phenomenal way of deciphering price action and giving you a real underlying perception of the buying and selling of smart money trading. All right, so let's move out to an hourly chart on the E-mini here. And you can see this blue box, that is that volume imbalance that I talked about for months now for the E-mini S&P. And these levels here are a daily bullish breaker. This is the high end of it, and this is the low end of the breaker. And you can see we had a market break higher, rebalance to a bullish breaker here, sent it higher. Look at the run here. Remember I was teaching you already. We have what? A lower high here, than here. So while this is relative equal highs, this is a easy or low resistance liquidity run that has no problem trading through it. Look at this. We have a higher high to the right than we do here. Are these not relative equal highs? Absolutely. But look closer. Fair value gap. See that? Draw that out in time. Bam. What does it need to do? Retrace more before it takes this relative equal high out over here. You see that? Look at this. Here's the low and the higher low to the right. So when the market's trading down, it's going to run through that easier than it would be if this low here on the right was lower than this one. But because it's higher, it's creating a much easier low resistance liquidity run to be rated and traded through. Lower high here relative to here. So this retracement down, how do you know it's not going to keep going down, Michael? Because the breaker's there and we made a lower low than the previous low. It's already done the rejection here, whereas we don't do the rejection here before dropping. So it's unfinished business. So you've heard me say this in recent months in tweets, or maybe hear me make a remark about it in my commentary. What is unfinished business? It's a term that I use as what I just showed you here. Unfinished business is this: when we have a lower high to the right with relative equal highs, or a higher low than the lower low on relative equal lows. So there's unfinished business down here, there's unfinished business above here. And wherever the dynamic is on the market for bullish, then it's going to run to this one and to do it with relatively easy, no real difficulty getting through it, because it has the lower high to the right. Okay, so it's very, very important that you understand that signature, and you can see it in every asset class. I've even seen it in Bitcoin. So it doesn't make me want to trade crypto. I'm just saying that these are some of the things I do see, but this is one of those lessons that are very, very deep. Okay, they're very dense lessons. And when I first introduce an idea like this, it plagues the new trader or the students in here with 1,000 different questions. And you're probably already starting to type up an email to send to me. Resist doing that. Resist doing it. Number one, because I'm backed up like crazy. I have questions literally 7 weeks old that I still haven't gotten into yet. So give me some time to get through some of the block of emails I got now. I can only get through about 350 of them a day. And I'm not doing it anymore on Saturdays and Sundays. So it's just so many of you. And you just got to give me time to get through it. But I'm telling you not to email me, because you need to go through the charts and start studying all the turning points. Like, this is a turning point, 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 that's a turning point, this is a turning point. And every turning point, study, was there a single high or relatively equal highs? And at the highs, is the high to the right higher or lower than the one to the left? And think about what I taught you here, because it sets the stage for a real low resistance liquidity run versus one that will still likely be rated and traded through, but may need a retracement ahead of absolutely going through it at a later time. All right, so let's go out to a daily chart. All right, so here's the daily chart for E-mini S&P, and this is that volume imbalance. I said if we traded through it and out and come back down in, which is we did here. Here, look at the bodies. It stayed within the volume balance. Here, we only went up into a little bit above consequent encroachment. This time, we went out of it with the bodies and back down in. I said, and go back and listen to the commentaries, I said if we did that, then the volume imbalance would provide the catalyst for a bullish move to the upside. Now, if we see a sustained run, say that this is just a knee-jerk reaction, and it might not be. It might be a more sustained decline. That I don't know. It's still Sunday and we just opened up. So I would be looking for signals to form on the basis of bullish institutional order flow on Monday and Tuesday to see if we start to trade higher. Should we do that above this high and then into this fair value gap would be the likely expectation for near-term bullishness for E-mini S&P. Now, if you look at the high here, okay, we have a low, the high, and a lower low than here. That's a breaker. That's what I'm defining here, okay? And if we drop back down into the hourly chart, notice that at that breaker, at this line right here, we have a run below this low here, then we we create a fair value gap. Fair value gap with a higher time frame bullish breaker, high probability. And also, this run to here, if you go down to a 15-minute time frame, that's an optimal trade entry. Rallies to a bullish order block, rallies, breaks down closed candle, rallies. So everything in here, bullish order flow. Okay, and we have relative equal lows. It trades down to clear the lows, rebounds the BISI, bullish order block, and this is where that divergence between the Dow and the NASDAQ. The Dow failed to make a lower low here as we hit a fair value gap with a bullish order block, and we ran above these highs. So this is where you can see old resistance broken becomes what? Support. Now you know when it works. You have to incorporate all the things I'm showing you here for institutional order flow, not just simply old highs broken, let's trade back down to it and find that as a buy, because I can show you a plethora of failures of that. You'll be hard pressed to find the things I'm teaching you here constituting a failure of this idea, because it's hinged on the underpinnings of the marketplace, the real things that make the markets go up and down. And you can see the underlying accumulation and distribution when you look at the relationships between the Dow, the NASDAQ, and the E-mini S&P. Factoring also the elements of the order block, market structure, all those things, it just makes it so nice to be able to trade index futures with this insight. It's not going to stop working. It's been like this forever. Okay, when I was starting in 1992, I wasn't interested in S&P. When I hear people talk about S&P, I was like, I don't want to do that. It's stuffy. To me, it felt like a snob market. I don't know how to explain it other than that. I just felt like only the goody two shoes was trading that.